And we do have a special guest who's going to be joining us later. It's Ryan Gibson, CIO of Spartan Investment Group, and he's the sponsor on this project. So he's going to show up a little bit later, talk a little bit about their sponsorship team, and join us for some Q&A. So without further ado, let's jump in. First off, disclaimer here, we do not offer tax, legal, or investment advice. Do your own due diligence and seek your own counsel. And with that out of the way, let's jump in. So this is the offering webinar for our DFW portfolio offering. Any questions you have, please type them into the chat window. All the offering materials, PPM, operating agreement, subscription agreement, etc., will be on our investor portal. You can find that at turbinecap.investnext.com, and we'll show you a little bit later on how exactly to get there. Subscription agreement and PPM should be available by the end of this week. We're just finalizing the final details on that. So quick little bit about who we are. Turbine Capital is I'm Tate Duryea, founder and CEO. I've been investing in real estate actively and passively for about the last decade, and formed this company because I thought, hey, why not take a couple thousand professionals with me on this journey? So our ethos is to empower pilots and other professionals to create passive income and multi-generational wealth through cash flowing commercial real estate without becoming a landlord, without actually learning how to do it yourself. So what we do is we go out, we find the best operators in North America, and we partner with them and pool capital together after performing rigorous due diligence on the operators, the markets, the deals themselves, and we pick the ones that we really like and we want to invest in ourselves, and we pool money to invest as a group. And as such, we have some much better power in numbers to do more robust due diligence, and we can get better returns as such, which we'll dive into. So just real quick to give, just kind of lay the landscape on commercial real estate as a whole. Different asset classes within commercial real estate, be multifamily, office, industrial, hospitality, self-storage, senior living, certainly a whole gamut of real estate to invest in. So specifically, why do we like the asset class self-storage? Well, a couple reasons right here. No toilets, cabinets, appliances, no countertops, super low maintenance. Easy eviction is a huge one. If someone doesn't pay their rent, we can very easily put a double lock on the unit. 30 days later, we auction their stuff, and the unit is swept out, and it's available for rent. High occupancy, it's a highly automated business. It's simple construction, and we have multiple profit centers. Lots of ways to add ancillary revenue, such as tenant insurance, propane, merchandise sales, such as boxes, packing tape, supplies, boats, RV storage, boat and RV storage, auctions, ICE, PO boxes, notaries, shipping services, U-Hauls, and even licensing cell phone towers on certain properties. Love the asset class for those reasons. So as a whole, the industry is a $37 billion annual industry. There's about $1.7 billion of total rentable square foot of storage in the United States. About 9.4% average of households use storage. And if you had 100 people in a room, you'd have about 540 square feet of storage demand. There's over 55,000 storage locations in the US at an average monthly cost of just under $88 per unit. And it's not just people with too much storage, too much stuff that needs to throw it in storage. Everything from local businesses, contractors, logistics companies, landscapers, you name it. We even, on one of the facilities that we're invested in with this particular sponsor, the Chamber of Commerce and a newspaper company rent from us. Industry highlights. This is a really great slide because it's a really important part of another reason why we love this asset class is that there's a lot of industry consolidation, and there's a ton of private equity pouring into the self-storage market right now. Bill Gates just became part owner of one of the largest self-storage operators, Public Storage, which is the largest publicly traded REIT. Just bought a competitor, Easy Storage, for $1.8 billion. Blackstone has just bought Simply Self Storage from Brookfield. KKR is getting into the business of buying storage as well. So lots and lots of institutional money moving into the space. And we're seeing a lot of industry consolidation and cap rate compression as a result. So we're in a very, very favorable position in the history of this asset class as we stand right now. So our operator that we work with, I don't think is any secret, Spartan Investment Group. They are fantastic. We've got an excellent track record with them, and we're in, I believe, 4 deals with them currently. So just a little background on them, and of course Ryan will jump in here and speak to this as well. But they've got 12,000 units under management, 55 employees, 250 million projects underway, over 400 active investors, of which Turbine Capital is one of those as a fund. They've raised 120 million in private investor equity and have taken 10 projects full cycle. What they do is a full service suite of acquisitions, syndication, property management. They have a vertically integrated property management team, which we've been very impressed with. Full asset management. They have an in-house construction team that handles all of the development and expansion. And of course, the business intelligence of when to sell and dispose of these assets, refinance, et cetera. Their current portfolio consists of 27 facilities under a national free up storage brand spread across Georgia, Florida, Tennessee. They just closed on a facility up in Wisconsin, Texas, Colorado, and Oregon and Washington as well. In Texas alone, Spartan operates 11 facilities currently, and they have a focus in the Dallas-Fort Worth and East Texas markets. With the acquisition of the DFW portfolio, Spartan will operate 27 facilities centrally located in the Dallas-Fort Worth Metroplex and in East Texas. And this is a market that we have had a great deal of success with in our previous deals with them, and will add to the economies of scale of this operator. So on to this specific deal. This opportunity is an 18 facility deal. It's 14 core facilities with 4 satellites. So the satellites are just very, very small automated facilities that are adjacent to 4 of the locations. And it's in the greater Dallas-Fort Worth Metroplex and also in East Texas. So a couple of high-level highlights here. It's in Dallas. We absolutely love Dallas. We'll talk a little bit more about why in a few slides. Very strong population growth. We've got 160,000 square feet of self-storage expansion on this deal. And because of high existing occupancy, the deal projects day 1 cash flow. As we'll see later on in the presentation, it's got great drive-by visibility with high daily traveled vehicles. The sponsor has secured some very attractive financing, which I think Ryan will speak to later. Economies of scale with other Spartan properties, which means they can use regional managers to manage multiple properties. Rents are below market as they stand right now, and there's lots of operational improvements that can be done to drive revenue. So jumping into the market, Dallas it's Dallas. It is the juggernaut of the syndication world. If you've invested passively at all in the last 5 or 10 years, you know Dallas. Texas has outperformed the broader US in terms of population growth by far. It was the fastest growing city from 2010 to 2019 in the US, adding about 1.3 million residents. It houses 21 Fortune 1000 companies. It's been recognized by Inc. magazine as one of the most dynamic and fastest growing cities in the world. It's also been ranked number 2 in construction permits for single family homes in 2020. It's the number 1 destination for companies leaving California. And everyone loves it, including the REITs. But we like to avoid those because they're really difficult to compete with. So what we like even more than Dallas is to be just outside in the suburbs, which is what this deal is. So The other half of the portfolio, 5 out of the 18, is in East Texas. East Texas is sort of made up of 3 MSAs, and those are Longview, Tyler, and Texarkana. If you've invested with us before, you certainly remember those names, Tyler and Longview. So these trios of this little trio of cities over there is actually a real hidden gem in the demographic ecosystem. It's on the Shreveport to Dallas corridor, and it's also in the Mexico-Canada corridor, right along the NAFTA corridor. It connects Mexico, the United States, and Canada right along there. And it's a hub for manufacturing, transportation, healthcare, distribution, processing operations. So 5 out of the 18 facilities are located there. It's less than a 2-hour drive from Dallas. And we have 5 other assets that we own in that market now. It happens to be this sponsor's best performing asset. It was the first deal that we ever raised for when we were looking at opportunities last summer as we launched our company. We loved that deal, and it was one that we felt comfortable raising for as our very first offering. And that deal has performed incredibly. The Tyler market is 99% occupied. We've got 2 out of the 5 facilities are in Tyler. The other 3 are in Longview, and it's an excellent, excellent market. So we're very excited about being able to add some more to our portfolio there. And that is the Tyler market. I guess I had some help here, didn't I? So as I said, the great thing about the best part about being in Dallas is not being in downtown Dallas where you're competing with the REITs, but being in some of these bedroom communities, 1 town or 2 towns outside of the DFW Metroplex. So we love the fact that we're there. The submarkets that we're in are these bedroom communities that are expected to have population growth of about 20 to 40% over the next 5 years. And they support the metro labor market, especially with this distributed migration patterns that are playing out across the country, where millennials are looking to get out of the city, out of that apartment, get a single family home with a lawn, space for the kids and the dog, et cetera. So as we see this sort of suburbanization trend, we love the fact that we can be in a fast growing city like Dallas, but just outside in some of these even faster growing bedroom communities. Have another view of this just right here. Might be a little bit easier to see. So nicely tucked around the fringes of the city. When you look at net migration, this is sort of getting into the end of the feasibility analysis. And this is just for reference, this in the presentation is just a sampling of the feasibility analysis that was done by the sponsor, which is a full 40-page document, and that's available or will be available very shortly on our investor portal. So if you'd like to take a look at that, you can certainly peruse that. So when you look at net migration trends, Texas is in the top 10% as a whole in the US. And then within Texas, there are 254 counties in Texas, and 6 out of the 7 counties that we're in, if I said that correctly. So we're in 7 counties with this portfolio. 6 of the counties out of those 7 are in the top 10 percentile of net migration in Texas. So we are in the top 10% net migration counties in a state that's in the top 10 in the US. So we're very, very happy with the population growth. One of the facilities is in Lamar County down there, which would be modest growth as opposed to outstanding growth for the rest of the portfolio. So jumping into the actual facilities themselves, it is an 18 facility portfolio. Like I said, 14 plus 4. We're looking at 5,046 units of self-storage, 503 RV parking spaces, and over 51,000 square feet of warehouse and office. Although there's about 250,000 square feet of expansion opportunity, the operator has only underwritten 160,000 for conservatism. The portfolio currently sits at 87% physical occupancy, 80% economic occupancy, which means that 80% of the facility is people that are paying their rent. About 7% are people that are there but are delinquent. And because of that relatively strong occupancy, we do predict day one cash flow. So the business plan that Spartan, and we've watched them do this time and time again on deals that were invested with them. They come in and they rebrand the facility to free up storage national brand. So they have a portfolio, a national brand portfolio called Free Up Storage. They've done ground up developments, but mostly they're in the business of value add, where they buy underperforming assets and bring them up to their brand quality. This facility is being, this portfolio is being bought for $88.5 million from a gentleman who is in his 80s, is done with it and wants to move to, I believe has already moved to Montana. So he's done very well, but there's a ton of meat on the bone to improve operations and bring these facilities up to fixed deferred maintenance, bring them up to standard, and improve operations. So rebrand the facility is the first thing. Next will be increasing rents to market rate. Training staff in order to enhance the user experience. They'll be developing community partnerships to drive more traffic to the facilities. That includes the social media ads and partnerships with the Chamber of Commerce. Develop corporate business relationships, and then add ancillary revenue streams through tenant insurance and retail sales. When they take over a facility, one of the primary drivers of ancillary revenue is tenant insurance. And while tenants are not required to use them for their insurance provider, it's the easiest thing to do, and they have a revenue share with those providers. So looking at the expansion, and hey, Ryan, looks like Ryan just jumped on the call, just saying hi. Looking at the expansion here, of the 14 core facilities, if you look here, there's 11 of those 18 locations have availability for expansion. However, only 5 of those locations were actually underwritten for the financial projections. So just a visual depiction of all 11 of these: Seaganville, Ferris, Krugerville, Paris, Mabank, and then Terrell, Lockbox, T80, and Flint, Tyler, Indian Creek satellites. So all of these are potential for expansion opportunities. However, only 5 of them have been underwritten, and we can go through those right here. So this is the first of 5 of expansion for the expansion plans, and this would be 40,000 square feet is planned here. This property conveys with an extra 40,000 square feet of expansion potential and market conditions that are favorable for the expansion. So this facility is currently 93% occupied with strong market demand. I believe market occupancy is at 97%. Over in Tyler, this next facility boasts a 99% market occupancy, and we're very familiar with the market. We have, as I mentioned earlier, we have 2 facilities located in Tyler. We plan to expand this facility by 55,000 square feet. Next is Flint. The Flint facility has room for about 10,000 square feet of expansion. It's got great visibility from that main road, and it's well occupied at 92%. Next is Ferris. Plan to expand this one by 30,000 square feet. And it's in a market that we really like. Again, Tyler, which is 99% occupied. And lastly, Paris, which is a 25,000 foot planned expansion, 98% occupied facility, and strong demand in the area. So this slide is one that I really like. This is from the sponsor's offering memorandum. And if we kind of go through here, this shows and highlights the 14 core facilities with the satellites sort of rolled into them. Shows the net rentable square footage in the first column there, physical occupancy on each facility, followed by economic occupancy, being who's actually paying their rent. The facility grade, and by the way, the plan through the initial improvements is to bring all these facilities up 1 letter grade from where they are right now, or at least a half letter grade. The market occupancy, and if you note there, all but 4 are 98 or 99% market occupancy. So very, very lot of capturable demand in these markets. Every single one of these facilities has capturable demand. Most convey with unimproved land that provide expansion opportunities. The next column over would be expansion that is underwritten. And we like the fact that only 5 are included in the projections, that there's upside not included in those. Population and income growth are both very attractive for all but 1 or 2 of the facilities, along with median income. Vehicles per day, very, very strong on most of them. We really like to see how well traveled these roads are. Zoning is very attractive. REIT presence is extremely attractive on most of these, where most do not have a REIT-owned facility within 15-minute radius. And then over there on the collections column, I really like this one. So this is the, if you add the delinquency, fixing the delinquency, meaning bringing economic occupancy up to physical occupancy, as well as the facility refreshes and subsequent increase in market rents, increase to market rents. These are the numbers for rental increases, factoring in both of those things. So diving into the financial, I'm going to touch on a couple things on this first slide, and then I'm going to hand it over to Jim to kind of walk through the rest of this. So if you notice, we're assuming a 50% revenue growth over the first 5 years. And what we really liked when we were analyzing this deal was that the sponsor did not base that just on market conditions. So breaking down sort of where these are coming from, 1/3 of the rental increases of this $7 million in year 1 to $10 million in year 5 is coming from increases on existing supply. And that is coming from a $3.4 million initial improvement budget to make the existing facilities as high quality as they can be from an experience perspective, both digitally and aesthetically. And that breaks down to about $670 per unit across the portfolio. So that means coming in, repaving drive aisles, fixing deferred maintenance, putting up new fencing, cameras, lighting, everything to make customers feel safe, secure, and like they're at a high quality facility that they want to stay at. Once those initial improvements are in place, the sponsor plans to start increasing market rents on the existing facility. So about 1/3 of that 50% revenue lift is coming from the existing supply. About a half is coming from the expansion of 160,000 net rentable square feet. And just because I don't think that we've put that in perspective anywhere yet, the existing portfolio at purchase is about 750,000 square feet. So we're going from 750,000 square feet to about 910. And then the last 1/6 is from assumed market growth. And what we really like about the sponsor's assumptions on this is that they have assumed a total of 7% organic growth over the entire 5-year hold period. And just to give you a benchmark of where that falls on this conservatism spectrum, there was an 11.2% year-over-year rent growth for the entire industry of self-storage from June 2020 to June 2021. So in 1 year, we saw 11.2% of organic rent growth in the storage industry last year, and they've underwritten a 7% increase over the entire 5-year hold period of organic growth, and that doesn't even kick in till year 3. So we're very happy with the conservatism on that. So in summary, we're sort of looking at below market rents, the expansion, and the operational improvements that are driving about a 50% revenue growth over 5 years, and that's based off of injecting about 15 to 20% on the initial cost basis. So the $3.4 million in initial improvements, followed by just over $9 million for the expansion. And Jim, do you want to go ahead and jump in here?
Yeah, sure. You have my slide ready?
Yeah, I've got a couple more where we sort of talk about the DSCR, and I'm happy to take this if you'd like, and then I can pass it over to you when you go to the scorecards.
That's actually fine, but just you actually touched on some of the things I was going to cover on the previous slide. I think obviously the good property mix, the conservative underwriting is a big thing that we're and Spartan is very good at this, being very conservative with their underwriting and leaving a lot of meat on the bone for potential outperformance, something that we really like. And those are the two main things I wanted to highlight on that slide you just showed right now.
The next one.
Yeah, I had this highlighted on my slide too. The DSCR, debt service coverage ratio, obviously a key metric when you're evaluating any opportunity. And one of the things we look for is we're looking for some headroom above what you see the ideal benchmark there is 1.25 to 1.3 times. Even some people look at 1.5 times. This one's projecting a 2.2 times debt service coverage ratio. That's more than enough headroom to be able to cover any sort of operational underperformance. You know, things do happen. Things may progress slowly, but there should be no risk in being able to service the debt during the period in question.
And I also wanted to highlight that in doing the math, this is interest only. So the 2.19x debt service coverage ratio is based on IO. But even if it was amortizing, we'd be sitting in year one at a 1.27x debt service coverage ratio, which is, just to compare apples to apples, even though we have the IO and we have a super, super healthy, almost 2.2 DSCR, we'd be sitting at a 1.27, even if it was amortizing from day one. So I'll kind of let you jump in here if you'd like to. This one's just highlighting the property tax. And actually, Ryan, if you're standing by, if you wanted to speak to the property tax increase and just sort of take this opportunity to hop in and talk about Spartan, that'd be awesome.
Yeah, it sounds great. Thanks for having me jump on here, Tate. Nice to see you, Jim. So property tax assumptions is something we really are familiar with and is probably one of the biggest threats to financials and risks that you have in the state of Texas. Texas is a non-disclosure state, meaning that we don't have to actually report the sales price of the properties. And if anybody's in real estate kind of understands that, when you buy an asset, if it's recorded with the county, they will actually take that newly recorded assessment or newly recorded purchase price and consider that in raising your tax assessment, which then applies a levy mill rate to it. And then they raise up your property taxes. And in this instance, we're showing just about 100% increase in property taxes over the 5-year hold. And we've done that for conservatism. We've done that because we're familiar with this market. We actually have an attorney that fights property tax adjustments and assessments for us on our behalf. And we believe that it's been pretty conservatively underwritten in that regard. So I think it's really important, when you're buying real estate, and especially in the state of Texas, that you consider that the property tax increases are considered in your financials. And we've basically have done that.
Yeah, I remember Ben saying that you guys have seen your assessments jump by 350% before, but you've never realized an assessment higher than about 100% gain. Is that right?
That's correct. Yeah, we've had some some interesting property tax assessment. They come after us to raise the property tax assessments quite a bit. And again, we've been very, very successful. We've had actually the most success fighting our property tax assessments in the state of Texas, because we're most familiar with the process there. And in this instance, we've shown it going up nearly 100%, which is the most we've ever seen it go up in any given opportunity.
Fantastic. Hey, while you're on, I'm sorry I don't really have a slide for you, but would you like to talk a little bit about Spartan? You can come back to this one.
Yeah, absolutely. So thanks for having me, Tate, again, and welcome everybody. There you go. There's a little bit about us. Spartan Investment Group was started in 2013, and our focus shifted over to storage in about 2016. We have about 12,000 storage units nationwide that we're operating under our Free Up Storage national brand. And we have about 55 employees that are full-time that service the assets. That includes everybody from contractors that we hire. We do all of our own construction. We have about a 10-person construction team. We have an acquisitions team that finds the deals. We have a capital raising team, investor relations team. And then we also do all of our own property and asset management. So we staff all the frontline employees at the facilities. We also oversee them with regional managers, and then up the corporate ladder, we even have corporate property managers and then director of operations. We've done that for over 250 million in worth of projects across the country. We're primarily in the state of Texas and Georgia, is where we have our most concentration of assets. But we're also in Washington, Oregon, Wisconsin, Arkansas, Tennessee, Florida, and Georgia. And so we've got about 9 states that we operate in. We have about 400 active investors. I believe that number is a little bit closer to 500 plus now. We've got investors that have invested anywhere from $50,000 to millions of dollars across of our platform. Our average investment size is about $375,000. And then we've raised about $120 million to date. And we have 10 projects that have gone from purchase, rehab, operations, and eventual sale. And we have about 27 facilities that are currently active today. And that's a little bit about Spartan.
Fantastic. And I can't reiterate enough how much we love working with you guys. We've watched you guys work time and time again with the deals that we're in with you, and you guys are great at what you do. So thanks for joining us today.
Yeah, you invested in one of our early portfolios, one of our first portfolios, and then one of our first self-storage assets. And I can't say enough good things about this opportunity. The financing that we've gotten on this opportunity in DFW is phenomenal. We're getting an institutional lending partner that's actually locked in about a 3.6% interest rate. And they've given us 60 months of interest only, which is going to really just underlying the cash flow for this facility. So really excited about the opportunity. Thanks, Tate.
That's excellent. Absolutely. So moving on to the different share classes that Spartan offers. And I think this is something that we kind of want to demystify here. And so you can absolutely go and invest directly with Spartan. They offer 2 different share classes. Their minimum investment is $50,000. And you have the return profile that's in the first column there. They also offer a $2 million share class, which is what Turbine Capital is purchasing. And we get about a 20% equity kicker. Both share classes have a 7.5% preferred return, but we see a significant bump in our upside because we're pooling a $2 million fund. So what we do at Turbine is we pool that money. We invest as one large investor, and we like to create win-win-win situations. So it's a win for our investors because they get the benefit of our due diligence process, our relationships, and our deal flow with some of the best operators in the United States, such as Spartan. We create a win for the operator, the sponsor, because they get to work with one investor rather than many dozens. And we can turn around and speak to our investor group, and then we create a win for our investors. We create a win for ourselves, right? Because we're able to capitalize on the delta between those 2 share classes. So as you can see here, equity investor projections for Turbine Capital investors are very, very similar, if not a couple basis points higher than that Spartan Class A share. So our goal is not to have any economic drag to our investors by coming through us and not give them any incentive to, cut out the middleman. We want to be, fully transparent on how we make money. And we think that it's a pretty great situation for all the parties involved. So these are the equity investor projections for Turbine Capital investors coming through us. And from here, I'll pass it back over to Jim. And real quick, Jim, would you mind just giving a little bit more on your background? Jim is our CFO here at Turbine Capital, and he is the one who does all of our financial due diligence, underwriting, and stress testing on any of the deals that we look at. And he's a stud. So don't be shy. Can you maybe we should have done this earlier, but if you can introduce yourself a little bit more and tell us about your background, and then kind of go through these slides.
Yeah, sure. Thanks, Tate. Yeah, hi, everybody. My name is Jim Morales. Over 20 years of a kind of diversified experience. Actually started out my career in IT, and most recently been somehow wound up doing a CFO work. My day job, I'm CFO for Grant Cardone, who owns almost 10,000 multifamily units, primarily in the Southeast Texas and a little bit up in the Mid-Atlantic area. I'm looking to expand that to almost 30,000 units. I've been partnering with Tate here on the side to help him build out his self-storage business through Turbine Capital and providing all sort of underwriting and financial management for Turbine Capital in that capacity. I've looked at a bunch of the Spartan deals in the past, and I've tried to always give him a little bit of a scorecard as kind of a framework. You've heard us talk about some of this stuff in prior slides. There's going to be a little bit of a recap here. But we like to look at a couple key things when we're looking at any sort of sponsor and the opportunity. Obviously, the market quality is one of the most important things to look at anytime you're looking at any sort of deal. And the DFW submarket and Tyler Longview area, very strong, significant population growth trends. The feasibility study that Spartan produced showed some really strong results and strong forecasts. That's why they like the market, and they built up quite a portfolio there. And we agree with them that the secondary markets are going to become a focus of institutional capital in the coming years. There's a lot of movement into this self-storage space by the BlackRocks and the other Wall Street firms. And as the more primary markets mature, they're going to look at the secondaries. And I think Spartan's positioned themselves very well. So we gave that a grade of an A. Overall business plan quality, Tate touched on this earlier. Spartan has a proven rebranding approach that has led to rental rate increases in the past across their existing properties, and we see no reason why they won't be able to achieve similar performance, if not outperformance, on this property. They have conservative expansion assumptions that we touched upon earlier. The available square footage to expand into, we're not underwriting, they're not underwriting expanding across all of that. There could be some extra meat on the bone there. And also, back to their existing local presence, the economies of scale, should be a, return multiplier over time. Obviously, we love Spartan. We've done several deals with them, 12,000 units across diversified geography. They've gone 10 full cycle across several projects there, from acquisition to divestiture. And we have an existing relationship with them, so we know them well and we trust them. And on all three metrics there, we grade them an A. On the pure financial underwriting side, another thing that we're really big on is how much skin in the game does the operator have. And in this case, both the operator and Turbine are both contributing capital to the deal, and Spartan is starting on the debt portion of the investment. Spartan's underwriting is some of the best I've ever seen. They're very conservative, and the deals still pencil out very well. There's terminal cap rate expansion built in. Some of the staffing assumptions, I believe they assumed a fully staffed model, even though they may not need to do that given the existing economies of scale. And the market growth is muted in the early years versus the market predictions. So there's a strong chance of outperformance, we feel, with the existing underwriting that's in the financial model. We did touch upon the debt service coverage ratio. Again, some very healthy headroom to accommodate fluctuations in operational performance. I think Ryan just confirmed it's going to be a 5-year IO, so that should extend for the life of the hold. So if there are any unforeseen issues with operational performance or achieving some of the pro forma predictions, there's more than enough headroom there to cover the debt on the property. And then the return profile is very strong here, right? Strong project level and limited partner returns is approximately a 2x equity multiple for investors. And we believe there's room for significant upside if the property outperforms the pro forma, which Spartan does have a track record of doing historically. So, for both qualitative and for financial factors and things that we look at in underwriting, we kind of graded this deal overall an A. We feel very strong about it. We feel very confident about Spartan's ability to achieve what's in the pro forma and their projections. And overall, we like the deal very, very much.
Thanks, Jim. Excellent. Couldn't agree more. And thank you for all your work tearing apart their underwriting. I know you had some late nights after your day job, so thank you. Taking it back to some next steps before we jump into Q&A with Ryan, myself, and Jim. If you are interested in participating, just find your way to our deal room. You can do this either straight through one of the emails that you got from us. This will lead you to the deal room on our investor portal. This will have all the details. Our PPM subscription agreement will be up there by late this coming week. And at that point, you'll be able to actually commit and fund. That process all happens right here from the portal. So once we go from preview to funding, it'll go from a soft commit to basically bringing you through the funding pipeline. So if you don't have one of our emails, you can simply go to our investor portal, and easiest way to get there is to go to our website, turbinecap.com, and click right there to investor login. That will bring you to this page. It'll prompt you to sign in or create an account. And then from there, very easy to create a soft commit. As of right now, that's all that's available on the portal is to soft commit. There's been some very strong showing for this deal so far, just based on our launch emails. And we really appreciate everybody that's gone in and done that. We only have $2 million to allocate for this deal. If I come back over here to the equity projections, Turbine Capital's equity raise is $2 million. So we reserve $2 million in this deal. And if I'm not mistaken, Spartan has already committed the remainder of that $37.5 million in equity for this deal. So we truly are the last $2 million available for this. And we look forward to bringing that to our investors. So this is on a first come, first serve on soft commits. And so we invite you to, if you haven't already and you'd like to participate, jump on there and submit a soft commit if you'd like to participate. And with that, I'd like to head into the Q&A. If you have any questions, please type it in the chat box. Looks like we have a couple so far. The first one would be, what is your exit cap rate? And Ryan, correct me if I'm wrong, but I believe that's 5.35.
That's correct.
Fantastic. And then as well on cap rate, since we're there, I thought this was interesting. Let's see, based on adjusted actuals to include the initial improvements, our purchase cap rate is 4.8. We're buying it as is at about a 5.03% cap rate. And we believe that, Jim, would you agree with me that a portfolio like this should trade between about a 4.7 and 4.9% cap rate today?
Yeah, that's correct based on market comps. And as like I mentioned earlier, the cap rate expansion, terminal cap rate expansion, they modeled into the financials there. As a sign of the conservative underwriting that we like.
Fantastic. We got another question. What are the frequency of distributions? So at Turbine, so we as a fund are going to mirror whatever the sponsor does. Spartan distributes monthly. And so we distribute monthly as well. We had a question on the preferred return of 7.5. So that is at a fund level, we are mirroring the 7.5% preferred return. So our fund level waterfall that returns our investors to their original economics, had they not invested through us, kicks in after that 7.5% preferred return. We have another question on bonus depreciation. Yes, a cost segregation study will be completed. Spartan is, and Ryan, feel free to jump in here if you'd like, but Spartan, I believe, does cost segregations on every single project they do. And bonus depreciation usually on these deals ends up being somewhere in the neighborhood of 30% of invested capital. And then Ryan, would you want to jump in here and just talk about the conservatism of the 5.35% exit cap, the terminal cap rate, and sort of what you're seeing in terms of private equity in the self-storage market right now?
Yeah, so I would say that cap rates are compressing and storage is becoming more valuable by the quarter, by the day. And we've seen multiple funds such as Public Storage, publicly traded company, Blackstone, Sovereign Wealth Fund, the Prime Group, which is the largest operator of self-storage. They're trying to deploy tens of billions into storage currently. And last quarter, last year, they were actually Blackstone was only able to deploy about 100 million of 2 billion. So there's a lot of money that's trying to get placed into storage. However, there's not an availability of deals because there's really just, quite frankly, not as much storage in the market as, say, multifamily or other asset class types. So it's really hard to place dollars in the space. However, the self-storage industry has done really well because of COVID, and rents are up over 10% year over year, as you mentioned earlier. So we show, people always ask us, how do you underwrite in a rising interest rate environment? Because I think that interest rates are going to go up, and they've been consistently down over time for the last 30 years, but interest rates might impact property valuations. So what we do is we actually show our cap rate going up in our projections, essentially showing the value of the facility going down over time for conservatism. So that means if interest rates do rise and cap rates do get worse, we'll actually be in an okay position based on how our underwriting has been done. And so we actually show, going in cap rate, like you said, about a 5.03%, but we show that getting worse every month, just for an ounce of, or a pound of conservatism on what the cap rate would trade at when we eventually sell the property. But as you kind of alluded to earlier, the reality is a portfolio like this, stabilized in today's market, is going to trade in the 4s, maybe even the high 3s, if it's packaged into $1 billion portfolio, which is what our plan is to do.
Excellent. Tagging on to the questions, I'd love to take the opportunity to just sort of address some of the risks associated with this deal. And a couple of them that I've outlined would be construction costs, the development, and the sponsor experience as to that development. We touched on interest rates, REITs, competitors, takeovers, and taxes. So can we start with the construction costs and your experience as a sponsor developing ground up and expansions?
Yeah, so I would say that, we've built about 3,000 storage units in the last 24 months. And one of the biggest things that we've seen is construction costs increase during COVID as steel prices have gone up, tariffs, et cetera. We don't use a lot of lumber. We use primarily steel and light gauge steel to construct our facilities. And we've seen rising costs. We've actually underwritten our construction costs to be 100% more than what we had projected just a year ago. And then on top of that, we have a construction contingency of 6.1%, or about $600,000 to further increase our construction conservatism on rising costs of steel. Even though we've seen kind of the market kind of go down a little bit lately, wood lumber prices have fallen a little bit and steel prices have kind of remained the same, but maybe just kind of stabilized. So we've underwritten a lot of conservatism in being able to kind of capture the rising costs of construction that has occurred over the last 24 months, and then what might occur in the future. The other thing that we do is we work with a steel provider that we have a lot of economies to scale with. The steel vendor that we're using is out of Boise, Idaho. They're Forge Construction, and they do all of our steel supply and construction of the facilities. And they actually, we lock in bids and then have the steel ordered and delivered to the site, so we can lock in contract prices very early in the process. We also have a good working relationship with them and do a lot of volume with them, which helps get discounts where needed on the steel.
Excellent. Could you also speak to your in-house construction team and their experience?
Yeah, so we have about 10 people on our construction team now. We get licensed in all the states that we do business with. Aaron Saunders is our director of construction. He has about 15, 20 year experience in building industrial across the country. If anybody's ever driven I-70 out to the mountains west of Colorado or west of Denver, he actually worked on the Eisenhower Tunnel and did a big ventilation project on that tunnel. And he leads our construction division, and he's in our office in Golden. And we've got a team that's done everything from use dynamite to blast granite in the mountains of Colorado to build a storage facility to, move and entitle wetlands and get multiple easements, conditional use permitting, rezoning properties to build storage. So our team has got a great amount of experience, and we're really growing our construction division right now so that we can keep everything in house, keep pricing and estimates, as good numbers as we go through the bidding process on these portfolios, and just kind of control the oversight of the and the quality of the construction.
Excellent. Thank you.
No problem.
One other risk I wanted to address was the REIT presence and other competitors. So, we aren't necessarily on this deal in the heart of Dallas, where we're going to be directly competing with CubeSmart or Public. But what do you see as the most likely competition in these markets? There is a lot of land out there. What do you see as development risk and competition risk?
Yeah, so I love this question because we're in the bedroom communities of DFW, and the bedroom communities are actually growing faster than the actual core of Dallas and Fort Worth. So we're in the communities like Waxahachie, Paris, Tyler, that are seeing, plus double digit or, single digit, low to mid single digit year over year population growth. And in a lot of markets, we're the only competitor. We own 3 of 5 facilities, as an example, in Terrell, Texas, and we'll have a very substantial presence in Tyler. And the REITs, they don't want to go build in the tertiary and the secondary markets and the bedroom communities. Their primary focus is in the core. However, they want to buy market share in the bedroom communities. And that's really kind of our, plays into our exit strategy very well. We've seen Blackstone and Simply express an interest in buying in the more bedroom communities and the tertiary markets, which we're at. So the other thing that we do, if you'll notice on the offering memorandum, we show an unmet demand by square footage for each property. And there's a surplus of unmet demand for every property, meaning that even if we build our additional square footage, there'll still be more room for someone else to come and build in those markets. And also, you've got to consider, if somebody's starting a business from scratch, it's going to be very difficult, capital intensive, to buy land, build a facility, lease it up, where we'll just have an existing business and a lower cost of capital and a better capital stack to compete on any price wars or anything like that. So we love developing in these markets. Yeah, there's risk of competitors coming in, but it's going to be very hard for those competitors to compete at this level. And then we love the fact that there are no REITs in these markets, which are our fiercest competition. We really don't like being in primary markets because the REITs can outcapitalize you. They can outspend you on advertising. And we are going to be the most sophisticated operator in these markets for DFW, which is great.
Excellent. Well, thank you, Ryan. I really appreciate you joining us, and we love this deal and can't wait to take it home with you. So thanks for joining, everyone. With that, really appreciate everyone being here tonight. If you couldn't make it and you registered, you'll receive the replay. And thank you very much. And we'll see you next time. If you have any other additional questions, please feel free to email us at info@turbinecap.com, and we'll definitely get whatever answers over to you. So thank you, Jim. Thank you, Ryan.
Thanks, Tate. Thanks, everybody.
All right, guys, take care. Bye-bye.